In January of 1929, I was responsible for $2.5 million. That was not a small sum then. I should tell you it is not a small sum now, but the truth is the number has lost its meaning to time. Let me put it another way. It was more money than a careful man could lose and still expect to be forgiven. I was that careful man. People said so. The analyst who weighed a business with cold, patient arithmetic, who never bought a thing he could not measure twice, who, if you had asked him in the summer of 1929 whether he was safe, would have shown you his ledgers and his hedges and said, with a calm I now find almost unbearable to remember, yes, quite safe. 3 years later, every dollar a person had handed me was worth 30 cents. The careful man, the one who measured everything, almost ruined. My name is Benjamin Graham. You may know me as the one who taught people to value a business with sober numbers, to never pay for a stock more than the figures could honestly justify. That is a fair thing to be known for, and I stand by it. But tonight I want to tell you about the years those same sober numbers turned in my hands and cut me. Because the lesson my name is attached to now, the one in the textbooks, I did not find it in a textbook. I found it on the floor. Here is the one thing I would like you to carry out of this. Hold it in your hand if nothing else survives the next half hour. Being right about value is not enough. You also have to survive being wrong. Those are two entirely different skills. And in 1929, I had mastered only the first. We will walk through it in 3 steps. First, the confident analyst I was before the fall, because the confidence is the part that should frighten you, not the loss. Then the fall itself, which was slower and far crueler than the famous crash you have read about. And last, what the wreckage taught me, once I had stopped bleeding long enough to look at it. Let me start with the confidence. But to understand my confidence, you have to understand the air I was breathing. The 1920s were a long, intoxicating climb. From 1921 to the autumn of 1929, the market rose something like 450%. Think on that. Nearly 9 years in which the general direction was up and up and up again, with only brief interruptions that always recovered. A whole generation came of age on Wall Street, having never seen a sustained fall. To them, to us, a decline was not a danger, it was a sail. And in that long climb, one tool was simply in the water. Everyone used it. Leverage, borrowed money. You bought stocks with a fraction of your own funds and the rest with the brokers, and as the market rose, that borrowing turned a good return into a marvelous one. It was not considered reckless. It was considered ordinary, sensible even. The men who did not use it were thought a little timid, a little behind the times. You have to picture the mood of it. Shoeshine boys offered stock tips. Cooks and chauffeurs bought on margin and spoke of the market as a sure thing, a kind of national escalator that only ever went up. Brokerage offices filled with people who had never read an annual report in their lives and did not feel the lack. In such a climate, caution itself starts to look like a character flaw, a failure of nerve, a refusal to see what everyone else can so plainly see. And I, who prided myself on caution, was not immune to it. I merely practiced a more sophisticated version of the same faith. I believed in my numbers the way they believed in their tips. I tell you this not as an excuse. I tell you because the most dangerous ideas are never the ones that announce themselves as dangerous. They are the ones that everyone around you treats as simple common sense. The reckless act that the whole world is performing alongside you does not feel reckless. It feels like belonging. So when I borrowed, I did not feel like a gambler. I felt like a professional. I formed the Benjamin Graham joint account in 1926 with my partner, Jerome Newman, Jerry. We took in money from people who trusted us, relatives, friends of friends, and we put it to work, and it worked. In 3 years, the account grew to $2.5 million. We were good at this. I knew we were good at this, and that knowing was the seed of everything that followed. There was one small sign, had I cared to read it. In the first half of 1929, we showed only a slight gain. After years of doing well, a flat stretch should have whispered something to me. Some part of the ground shifting. It did not. When a man is certain, the warnings arrive in a language he has decided not to speak. Now, understand, I was not reckless, even by the standards of a reckless age. I need you to believe that because it is the whole point. A reckless man losing his money teaches you nothing. You already know not to be reckless. It is the careful man losing his money that should keep you up at night. I thought I had built a fortress. I held long positions, the stocks I believed in, the ones my analysis said were worth owning. And against a good portion of them, I held short positions, bets that other weaker stocks would fall. The one would offset the other. If the market dropped, my shorts would rise and cushion the blow to my longs. Hedged, balanced, symmetrical, even the way a good proof is symmetrical. On paper, the arithmetic was sound. I had done the arithmetic myself. That was the trouble, because the arithmetic only sees what you place in front of it. What I did not write into the ledger in plain enough ink was this. Beyond the hedged portion, the balanced part I was so proud of, I held a large block of stocks that were not hedged at all. Naked, as we say, and against those I had borrowed. I was holding them with money that was not mine. Let me be more precise, because the precise shape of it is the lesson. For every dollar of my own capital, I had put well more than $1 to work in the market. The hedged book, the longs balanced against the shorts, that part I could have defended in any classroom in the country. It was the rest that undid me. A large position, held long, unbalanced, and carried on money I had borrowed against it. On the way up, that arrangement is invisible. It simply makes a good year look like genius. It is only on the way down that you discover you do not truly own what you thought you owned. You are renting it. And the landlord can call at any hour he likes. That borrowing has a gentleman's name. We call it leverage. We call it margin. The names are calm and respectable, which is precisely how they disarm you. Let me give you a truer picture of it. Think of leverage as a rope tied around your waist, hauling you up the face of a cliff at twice your natural speed. On the way up, the rope is a marvel. You cover in 1 year what should have taken 2. Everyone admires the rope. Everyone wants a longer one. What no one mentions, what I did not let myself dwell on, is that the same rope, tied to the same waist, hauls you down at twice your speed the moment your footing goes. And the rope does not pause to consider your character. It does not care that you are a careful man, that your analysis was excellent, that you meant well. It knows only one thing, which direction you are falling. Then it doubles it. So here is the question I could not ask from inside my fortress. If I had hedged so carefully, if I had been so balanced, so measured, why was I not safe? I want you to hold that question, because I held it for 3 years and paid $2.5 million before I could answer it. We will come back to it. Keep it in your pocket. In September of 1929, the crash everyone remembers arrived. You know the images. The averages cut in half in a matter of days. The ticker running hours behind the trades, so that a man could not even learn how poor he had become until evening. Fortunes erased between lunch and dinner. And yet, and this is the strange part, the part that nearly destroyed me precisely because it did not destroy me then, that first year, I came through almost unharmed. My account was down about 20%. The market had fallen a great deal more. I remember the feeling distinctly. It was not fear, it was vindication. The fortress had held. The careful man had been right to be careful. I had survived the thing that ruined the reckless, and some quiet voice in me said, you see, you did know what you were doing. That voice was the most expensive thing I owned, because my real troubles did not come in the crash. They came in the 3 slow years after it. Here is something I have come to believe. A crash is loud, but a depression is quiet. A crash is a single blow. You can see it, name it, tell the story of it at dinner. A depression is something else. It is the slow, patient tightening of a rope, a 1/4 inch a month, in a room where the lights are gradually going out, and no single day is dramatic enough to be the day you finally panic. In early 1930, the market recovered, genuinely recovered. By that April, it had climbed back a long way, better than 40% up from the worst of the previous autumn. I let myself believe the worst was behind us, and I was not alone in that belief. That was the cruelty of it. The recovery was real enough to trust, real enough to lure a careful man into staying exactly where he was. Then a bank failed in Austria, far away, in a country most of my clients could not have placed on a map. And the whole fragile recovery began to come apart at that seam, and a second decline set in, and this one did not stop. I will give you the years plainly the way I gave them to myself afterward, because the plainness is the only honest way to carry them. The year 1930 was the worst single year in the 33 years I managed money. Worse than 1,929, worse than anything before or since. We lost 50.5%. Half in 1 year, after I had already been cut, and by now my cushion was gone. I had been forced to cover my short positions earlier. The very hedges that were supposed to protect me sold off to meet the pressures of the moment. So there was nothing left to soften the second fall, nothing balanced anymore, just the naked positions and the debt. That is the part I want you to sit with. The debt did not fall with the market. The stocks fell. The debt stayed exactly where it was, full size, indifferent. When you owe a great deal, and everything you own is shrinking by the day, a quiet thing happens that no ledger warns you about. You stop being at the mercy of the market. The market, at least, is impersonal. You become at the mercy of your creditors, and creditors are people, frightened people, who can decide your fate on a Tuesday afternoon for reasons that have nothing to do with the value of what you hold. And there is not a single line of your beautiful analysis that you can say to them that will matter. I learned in those years to dread the telephone. A falling market does not merely lower a number on a page. It tightens a hand around your throat by slow degrees. When you owe against your holdings, every decline carries the quiet possibility of a call, not a social call, a demand asking you to put up more money you do not have or else to sell at the worst possible moment the very things you were most certain were cheap. Do you see the cruelty of it? You are forced to sell low precisely because you bought with borrowed money. The leverage does not only magnify your loss, it steals from you the one thing a value investor needs above all others, the freedom to wait. I thought I had worn a raincoat into the storm. I had simply forgotten that the water was rising from below my feet, and a raincoat, however good, does nothing for a man standing waist deep in a flood. The losses went on into 1,931. Another 16% gone. By then, the thing had stopped being about money in the abstract. It had become about specific, humiliating human acts. I began selling personal possessions. I borrowed from friends. I borrowed from family. We gave up our home, the grand one, and moved the family to a cheaper apartment. Still respectable. I will not pretend we were put out into the street, but a man knows the exact weight of the word cheaper when he is the one who has to explain it to his wife and his children. Every economy was a small confession. Each one said plainly to the people I loved, I was not as safe as I told you I was. And one of the things that kept the account breathing at all came from my partner's father-in-law, Jerry's wife's father. Let me make sure you feel the weight of that, because I felt it every day. A man connected to me only through my partner's marriage reached into his own pocket to keep my fund alive. I did not have the luxury of pride. I had only the obligation to be worth that trust someday. And there was a decision Jerry and I made in those years that I am still not certain was wise, only that it was right, and that the two are not always the same thing. Under the terms of our agreement, we were entitled to no payment, none, until every loss our investors had suffered was earned back in full. We could have renegotiated. Men in worse spots did. We honored it instead. For years, we worked the same long days, the same hard analysis, the same labor as in the good times, and we took nothing out for ourselves. Nothing at all, until the people who had trusted us were made whole again. Some of them could not wait for that day. They came to withdraw what little of their money remained, and I did not blame them, and I do not blame them now. I remember one in particular, a strong man, capable, the sort who does not flinch. He came to take out his funds, and he apologized to me, as though he had done something shameful because he needed money that was his own. I learned only later that after he left my office, he wept. He had lost more than $1 million of his own fortune. That is what those years actually were. not numbers on a page, strong men, good men, apologizing through tears for the indignity of needing their own money returned to them. I want to be honest about my own part in those scenes, because it would be easy to tell this story as a man wronged by history. I was not wrong. These people were poorer because they had trusted me and I had been wrong. Every apology they offered me was an apology I should have been offering them. I sat across from frightened friends and accepted their gentleness when what I had earned was their anger. That, too, is a weight you carry long afterward. By the end of 1932, the arithmetic had reached the bottom of what arithmetic can do to a person. We had kept making our quarterly distributions to the investors who stayed small payments charged against Jerry's capital and mine because we would not stop honoring them. And when the dust of that year settled, there was 22% of the original sum remaining. The Dow had fallen to around 42 that June, a number that seemed to belong to some other poorer century. Let me try to describe the bottom, because the bottom has a particular feeling that the numbers cannot give you. It is not panic. Panic is for the crash, for the loud days. The bottom is quieter and worse. The bottom is when you have stopped expecting rescue, when the morning no longer brings the small flicker of hope that today is the day the tide turns, because you have felt that flicker too many times and watched it go out. You begin to suspect that this is not a storm you are waiting out. You begin to suspect this is simply the climate now, and that you were a fool ever to have imagined otherwise. I would sit at my desk in the evening with the day's quotations spread before me and find that the careful work, the very thing I had built my name and my self-respect upon, had bought me nothing that day and might buy me nothing the next. There is a particular loneliness in doing good work that the world refuses to reward. It is not loud. It does not announce itself. It simply wears you down, evening after evening, until you begin to wonder whether the work was ever worth anything at all. That was the true danger of those years. Not the losing. The losing I could measure. It was the slow erosion of the belief that anything would ever be different, that there was any point in careful work at all, in a world that seemed to have decided that careful work would not be rewarded. I came very close in that stretch to a kind of defeat that has nothing to do with money, the defeat of a man who stops believing his own method. And yet I want to tell you the question that in the end pulled me back from it, because it is the same question I left in your pocket a few minutes ago. So let me say it as plainly as I can. The most careful analyst on Wall Street, the man who measured everything, who built the fortress, who came through the crash itself almost untouched, had lost 70% of what he had been trusted with. And here is the question. If careful analysis could not save me, then was the whole method wrong? Had I built my life on a mistake, or was I missing one single thing, something small enough to overlook and large enough to ruin me? Let me answer it, because I lived inside that question for 3 years, and the answer is the only thing of value I brought out of the wreckage. The method was not wrong. I had not failed because I valued businesses badly. Many of the stocks I held were worth precisely what I had judged them to be worth. The values were real. They were simply held underwater while the tide refused, year after year, to turn. Being right about them did not save me, because the market can stay unreasonable far longer than a borrowed man can stay solvent. I came to think of the market in those years as two different creatures wearing the same face. In the short run, it is a voting machine. It tallies up the hopes and the fears and the fashions of the crowd, and in a panic, the crowd votes with its terror. But in the long run, it is a weighing machine. Eventually, it sets the popularity aside and weighs what a business is actually worth. My mistake was not in the weighing. I had weighed correctly. My mistake was forgetting how long the voting can go on, how many years the machine can keep tallying fear before it finally consents to weigh the truth. I was right about the weight. I had simply borrowed against the votes. I failed in the end for a simpler reason than a wrong method, a more humbling one. I had left myself no room to be wrong. Let me say the hardest sentence first, the one I later wrote about myself, in plain words, because I had earned the right to say it plainly. I was 100% wrong. Not about the values, about holding all of them, fully with borrowed money as though I were certain the future would be kind to me. I had done brilliant analysis and then set it on a foundation that quietly assumed I could not be mistaken. And if a market guarantees you anything at all, it is this: sooner or later, in a way you did not forecast, you will be mistaken. I had confused being careful with being safe. They are not the same thing, and the gap between them is where fortunes go to die. I was careful meticulously, almost vainly careful in my judgment of each individual holding, but I had been reckless in the one decision that sat above all the others. How much could I lose and still survive? A man can be right about every single tree in the forest and still be standing in it when it burns. So what had I been missing? Not sharper arithmetic. I had arithmetic to spare, a buffer, a margin, room. Let me show you what I mean with a picture I have never been able to improve upon. Think of an engineer building a bridge across a river. He studies the traffic. He calculates that the heaviest truck that will ever cross it weighs 10 tons. Now, does he build the bridge to hold 10 tons? He does not. If he is any good at all, he builds it to hold 30. Why 30 when nothing he expects will ever weigh 30? Because he respects everything he cannot predict: the flaw in the steel he cannot see, the freak storm, the overloaded truck that ignores the sign, the load no one in his office thought to imagine. The distance between 10 tons and 30 is not waste. It is not timidity. That gap is the entire reason his bridge is still standing when the cheaper, cleverer, perfectly calculated bridges have fallen into the river. That gap has a name. I gave it one: the margin of safety. In 1929, I had built a bridge rated for exactly the traffic I expected. My calculations were correct. And the bridge collapsed anyway, not because the arithmetic was wrong, but because I had left no space between my best judgment and my ruin. The moment the unexpected truck arrived, and in markets it always arrives, there was nothing between me and the river. And here is the part that still strikes me as strange, even now, all these years later. The cure was lying all around me. In the very wreckage I was standing in, by the bottom, in 1932, the market had become so frightened, so blind, so indiscriminate in its despair, that it was selling dollars for 30 cents and not bothering to count the change. So I set my students at Columbia to a piece of plain, unglamorous, foot-slogging work. We took some 600 companies listed on the New York Stock Exchange, and one by one we matched the price the market was charging against the plain value sitting on each company's own balance sheet. Understand what that work cost. There were no machines to do it for us. My students and I went through it company, by hand, in a world before computers, reading balance sheets, copying out figures, matching each price against each value 600 times over. It was tedious beyond description, and the tedium was the whole point, because the opportunity was hiding precisely where no excited man would ever bother to look. In the dull columns of a financial statement that everyone in 1929 had been far too thrilled to read, the results startled even me, and I was not a man easily startled by a balance sheet. More than 200 of those 600 companies, 1 in every 3, were selling for less than their net quick assets. And more than 50 of them were selling for less than the cash they had sitting in the bank. I want you to read that slowly, because I had to. You could have bought the entire business, every desk, every factory, every contract, the whole living concern for less than the money already sitting inside its own accounts. The market was so terrified that it was handing you the cash and throwing in the company for free. I had spent the whole of the 1920s hunting for a single such bargain at a time, prying them loose from the market one by one with great effort. Now, in the ruins of 1,932, they lay everywhere in the open, and almost no one would touch them. That is the cruel symmetry of markets. The safest time to buy is very often the time you are most afraid to, because everyone around you is selling, and every instinct in your body is screaming that careful work is folly. The margin of safety tends to be widest at the exact moment your courage is thinnest. That is a margin of safety you can see with your own eyes. You are not betting on a brilliant future. You are not telling yourself a hopeful story. You are buying $1 for 60 cents, and if the future turns out merely ordinary, you win, and if the future turns out poor, you very often still do not lose. The protection lives in the price you paid, not in the forecast you made. The price is a fact. The forecast is a wish. So I did the thing my own ruin had just finished teaching me. I bought carefully, this time, with a buffer between my judgment and my survival. And slowly, because the depression did nothing slowly except end, the account climbed back out of the hole. It did not come in a rush. There was no single triumphant morning. It came back the way the losses had come slowly, quarter by quarter. A little ground recovered and held, then a little more. The same patience that the falling years had tried to grind out of me turned out to be the very thing that carried me back up. I had not outsmarted the depression. I had outlasted it. There is a great difference between the two, and a surprising amount of investing lies inside that difference. I think on that often. The market did not reward me, in the end, for being the cleverest man in the room. It rewarded me for being one of the few still standing in the room when the others had gone. Brilliance is common, and it is fragile. Survival is rare, and it compounds. Given long enough, the patient and the solvent inherit nearly everything the brilliant and the leveraged are forced to give up. I had to be ruined once to understand which of the two I would rather be. By 1935, we had earned back what we had lost. The people who stayed with us were made whole, and Jerry and I were paid, at last, for the years we had worked for nothing at all. And in 1,934 inches, the very middle of the digging out, before I even knew the story would end well, I sat down with a former student of mine, David Dodd, and we wrote it all down. We called the book Security Analysis. And somewhere in its pages, we set those 3 words down for the first time, margin of safety, and tried to explain why they mattered more than any clever forecast a confident man could make. I want you to notice where that idea came from. Not from a comfortable study, not from a winning streak. I dug it out of the worst 3 years of my professional life with my own hands because I needed it to be true in order to go on. Now let me tell you the part the numbers leave out. I have given you a great many numbers tonight, and every one of them is true. But the numbers are not the thing I actually carried out of those years. The heaviest weight was never the money. Understand, I have been poor before, far poorer than this. I grew up without a father, with a mother who could not earn, and I knew real hardship long before I ever knew Wall Street. So it was not the shrinking of my fortune that nearly broke me. A fortune is only a number, and numbers I could bear. It was the slow attrition, the repeated false dawns, the mornings the tide seemed at last to turn, and then quietly went back out, taking a little more hope each time, the not knowing whether any of it would ever end, or whether this was simply the shape of the rest of my life. And above all of it, the faces, the relatives, the friends, the people who had handed me their savings because they trusted the careful man. They were as frightened as I was. More, perhaps, because they could not see the ledgers and I could. And they looked to me to tell them whether they were going to be all right. And I had no honest answer to give them. I could not promise. I had promised once already, with my calm and my hedges and my arithmetic, and the promise had failed in their hands. For 3 years, I carried their faces to bed with me. Not the numbers, the faces. The cousin who had handed me a wedding's worth of savings. The friend who had said, put it wherever you put your own, Ben, I trust your judgment. I had put it exactly where I put my own. That was the trouble. My judgment had been the danger, and I had generously shared it. That is what my certainty cost me. Not only the dollars, the right to look the people I loved in the eye and tell them truthfully that the careful man had kept them safe. So here is the truest thing I know about money, and I had to lose almost everything to learn it. The danger was never only the market. The danger was my own certainty. A margin of safety is not really a financial technique at all. It is humility, wearing the clothes of arithmetic so that proud men will let it in the door. It does not protect you from being wrong. Nothing on this earth protects you from being wrong. It protects you from being sure. It is the room you leave deliberately for the plain fact that you are a human being, forecasting a future that has never once asked your opinion before arriving. Build a bridge for 30 tons. Always. Not because you expect the storm. Because you are not the one who decides when it comes. It took me 30 years in this business to learn one quiet thing. The most dangerous man to my money was never the speculator across the floor. It was never the panic in the street. It was never, in the end, the market itself. It was the careful, confident fellow looking back at me from the mirror, perfectly calm, perfectly measured, perfectly certain he had it all counted. I do hope you make his acquaintance a great deal sooner than I made mine.